Crispy Delight Food Industries began as a small family business in Kuala Pilah, Negeri Sembilan in 2017, specializing in packaged banana chips. As the business grew, it relocated to a largest production facility in Senawang in 2024. Today, the company distributes its product across 3 states, which are Negeri Sembilan, Melaka and Johor. The transition to a formal master budget is a critical step now because management plans to expand distribution throughout Peninsular Malaysia. This coordinated budget is essential to ensure the company can effectively plan its cash, financing, and operations to support its nationwide growth.
So now we are going to the importance of budgeting. For the firstly, planning. Budgeting helps a company estimate future sales, production requirements and cash needs. This allows the company to prepare its resources before expanding its operations. Secondly, coordination. The master budgets ensure that all departments such as sales, production, purchasing and finance work together based on the same assumptions. This improves communication and avoid conflict between departments. For the thirdly, cash and resources planning. Budgeting helps management identify future cash requirements and plan major purchase, such as new machinery or delivery vehicles before they are needed. Next is control. The budget acts as a benchmark to compare actual performance with planned performance. If there are any variance, management can investigate the cause and take corrective actions. The fifth important is performance evaluation. Budgeting allows manager or departments to be evaluated based on their budget targets, making it easier to measure accountability and performance. Lastly is decision making. Budget information supports better business decisions such as setting selling price, controlling costs, and determining the most profitable sales strategy through analysis like cost volume profit or CVP analysis. In conclusion, budgeting is not only a financial planning tool but also an important management tool that supports planning, coordination, control, performance evaluation, and effective decision making.
So now that we understand why budgeting matters, let's look at how Crispy Delight's master budget actually comes together. It all starts with one number, the sale forecast. For quarter 1, there are 30,000 units in January, 32,000 units in February and 35,000 in March. From there, everything flows in sequence. The sale budget drives the production budget. How many units do we actually need to make? Once we account for inventory policy, production then drives our materials, labor and overhead needs. How much banana, how many labor hours and how much overhead costs. All of that fits into the cash budget because at the end of the day, management needs to know, do we have enough cash month by month to pay for all of this? And finally, everything rolls up into our 2 financial statements, the income statement and the balance sheet, which is how management judge the overall performance of the quarter.
For the first quarter of 2026, the company has set ambitious sales targets that show steady monthly growth, which are January 30,000 units, February 32,000 units, March 35,000 units, which is the total is 97 units at all. At a selling price of RM18 per unit, this results in total budgeted sales revenue of 1,746,000 for the quarter. However, because all sales are made on credit, the total cash collections are 1,620,900 differ from the revenue figures. The company operates on specific collections terms where cash is received over a 3-month period, 55% in the month of the sale, 25% the following month, and the final 20% 2 months after the sale.
Next, for the slide production, materials and the cash budget, moving on to our operational and cash requirements. For the first quarter of 2016, we have scheduled a production volume of 98,500 units, which requires a raw material purchases totaling 223,648 ringgit. Our primary cash challenge occurs in January. We are planning a major capital expenditure of 240,000 for the automated slicing machine, packaging machine, and a new delivery truck. Due to this significant investment, our operating cash flow in January is insufficient to maintain our 60,000 minimum cash balance. Therefore, we have planned to draw 41,000 from our CBCB Bank Revolving Credit Facility. The good news is that with strong sales collections in February and March, we are able to fully repay the loan, including 1,230 in interest, by the end of the quarter, leaving us with a healthy ending cash balance of 388,523. Next, this slide summarizes our final financial position for the Q1 2026. Based on our budgeted income statement, we project total sales revenue of 1.746 million. After accounting for the cost of goods sold, operating expense, and the one-off employee bonus of 150,000 in March, we are forecasting a net income of 595,504. Looking at the statement of financial position, the company remains in a very strong financial position. Our total assets are now valued at 2.125 million, with very manageable liabilities of only 23,920. This indicates a robust equity structure, and most importantly, our assets are perfectly balanced with total liabilities and equity, confirming that our master budget is both internally consistent and realistic.
So now, I will explain the results for question 1, which is the contribution margin and break-even point. First, the contribution margin per unit is 11.55 ringgit. This is calculated by subtracting the variable cost of 6.45 ringgit from the selling price of 80 ringgit. This means that every unit sold contributes 11.55 ringgit towards covering fixed costs and generating profit. Next, the contribution margin ratio is 64.2%. This indicates that 64.2% of every ringgit of sales revenue is available to cover fixed costs and profit, while the remaining 35.8% is used to cover variable costs. Based on this contribution margin, the company needs to sell 24,749 units to reach the break-even point. At this level, the company covers all of its costs but does not make a profit or incur loss. In terms of sale revenue, the break-even sale value is 445,479 ringgit. Finally, the budget sales are 97,000 units, which is 72,251 units higher than the break-even point. This represents a margin of safety of 74.5%, showing that the company is expected to operate well above the break-even level. Therefore, the risk of making a loss is relatively low as long as sales remain close to the budget target.
Puan Farah asked us to look at what happens if we raise the selling price by 50% and 25%, while also spending more on advertising to support the increase. In the base case, at 80 ringgit a unit, our contribution margin is 11 ringgit 55 and that gives us an operating income of 834,000. Now, if we raise the price by 50% to 20 ringgit 70, our contribution margin jumps into 40 ringgit 25 cent per unit. Even after spending an extra 10,000 on advertising, operating income increased by 251,000, pushed the price up by 25% to 20 ringgit, and even with 15,000 more in advertising, operating income increased by 421,000. So on paper, both increases are clearly worth it. And this is important, this analysis assumes our sales volume stay exactly the same at 97,000 units. In reality, a price increase could push some customers away, especially as we are entering new, more price-sensitive market. So before committing to either increase, management really needs to look at price elasticity and what competitors are charging in each region.
Profitability and expansion strategies. A key part of the financial analysis is determining what is required to reach a target operating profit of RM 300,000. According to the analysis, the company needs to sell at least 50,549 units during the quarter to hit this profit target. So because of the current budget is at least 97,000 units, the company is already 450 units above its target, meaning the desired profit is well secured with a healthy margin. So to continue this growth and safeguard its position during nationwide expansion, the sources outline 6 strategies initiatives, which are geographic expansion, moving into new states beyond these 3 that already have broaden reach, utilizing supermarkets, e-commerce platform, and also export markets. Third one is product innovation, launching new flavors or maybe premium or family packs and also healthier variants. Fourth, enhanced marketing, boosting promotions through a dedicated digital marketing budget. The fifth one is distributor incentive, strengthening trade terms to encourage push selling in new market. And the last one is operational efficiency. So about maybe improving production and negotiating better bulk prices for raw materials, which is bananas, to maintain high contribution margins.
And finally, for the last questions, how CVP analysis can assist management in pricing decisions, cost control, sales planning, risk assessment, and profit forecasting. First, for pricing decisions, CVP shows us exactly how price changes flow through to our bottom line, helping us set competitive prices in new states. Second, for the cost control, by separating fixed and variable costs, we can focus on the areas that offer the greatest savings as our production scale increase. Third, for sales planning, the break-even and target profit formulas allow us to set concrete sales targets for each new region. Fourth, for the risk assessment, our margins of safety serve as a critical flex, indicating how much room we have before we hit a loss, especially as we take on new fixed costs like machinery and trucks. And lastly, profit forecasting. It allows us to quickly model our operating income under different volume and cost scenarios without having to rebuild the entire budgets from scratch. In essence, CVP serves as our strategic compass for this expansion.
Overall, Crispy Delight is in a strong position going into this expansion. We are projecting a net income of RM595,000 for the quarter. We have a healthy 64.2% contribution margin and a wide margin of safety above our break-even point. The numbers support moving ahead with the nationwide expansion plan. Based on everything we have covered, we have 5 recommendations for management. 1. Adopt for this quarter 1 master budget as the official benchmark and track actual result against in every month. 2. Confirm the RM41,000 drawdown with CB Bank ahead of January, since that when the crash happened. 3. Use the CVP relationship we have shown to guide pricing decision as we enter new region. 4. Don't start at quarter 1. Roll this budgeting process forward into an ongoing quarterly cycle. And last, revisit our inventory policies periodically since 25% and 15% buffers might not stay optimal as sales grow.